Hello, everybody. I'm here today with Laura Maddison from Raymond James. Hello, Laura. Lovely to see you.
Hey, Ruby.
A little bit of background as to who Laura is, for those who don't know her. She specialises in the technology and services sector and is one of the founding members of the London Raymond James team, where she joined, I think, in 2017. Is that correct?
Yes, yeah. Feels like yesterday.
It does indeed. Laura has over 18 years experience of advising private equity, corporates and entrepreneurs on deals across the breadth and depth of the technology and services sector, which includes areas such as EdTech, GRC, ESG and marketing. And you joined, I believe, Raymond James from Deloitte, where you were you responsible for M&A for the TMT team there?
Yeah. I was a director in the lead advisory team on the CMT side, or CMT was kind of the old name for tech and services. So similar coverage, but just a slightly different badge.
Fantastic. Now we're here in 2023 talking about the state of the market. Thank you
Yes.
very much for making time to have a conversation with me. I'm sure there's lots of people that have been very keen to understand your thoughts and comments. So what I'd probably like to start with, if I may, is just a general sort of commentary from you as to what do you think the market has ready for the year ahead?
Yeah, so look, I think it's an interesting topic to open up on the state of the market. I mean, there's lots going on, as we've all seen through the headlines. I think the headlines about the financial markets have been pretty deafening, whether that's through kind of the rising global inflation rates, fueling cost of living, energy crisis in Europe, which has responded to interest rates like we've never seen in the last 15 years. Then flipping that into kind of the lower GDP growth and the kind of recessionary concerns that are growing across all geographies, but particularly in Europe. It's fair to say that has some kind of interesting implications for M&A and kind of what we're seeing. And for me, they fall into a few different categories. So principally on the debt side, we have enjoyed, much like in the consumer market of mortgages, we have enjoyed exceptionally cheap debt for a very long period of time. And off the back of our wonderful government and the Rishi Trust lettuce debacle, we saw that change pretty dramatically almost overnight. So the kind of eras of the very cheap debt has gone, which has implications from an M&A perspective, because that is the kind of the fluid, particularly from a private equity perspective, that kind of keeps deal flow moving. So I think that's a fundamental shift around not only the price of debt, but also the availability of debt. I think from the investor side, we have seen, and we are going to continue to see more of a flight to quality. And again, what does that mean? It means there's a higher bar, there's a greater level of scrutiny coming from ICs across the market. And that plays out in a few different ways. That plays out into, appetite to transact. It plays out into perhaps slightly longer, more sustained DD process, due diligence exercises, where people just want to check just a bit more and kind of do a bit more in-depth work than previously. But I think contrasting that on the investor side, we're also seeing, record amounts of dry powder across the private equity landscape. If you go back 5 years, it's probably almost doubled. It's higher than it was last year. So, no one can afford to sit on their hands. Similarly, from a corporate perspective, record amounts of cash reserves. So actually, some of the fundamentals remain quite strong, but there's undoubtedly pressures. And what does that mean in terms of, I guess, valuations and volume? Valuations, we've certainly seen some contraction. I think we'll come on to talk a bit more about that later. Albeit, again, it's quite a bifurcated market. You've got some assets have definitely kind of had some sort of valuation hit, whereas some of the premium assets are actually still commanding the sort of multiples they might have achieved 12 months ago. So it's quite a bifurcated market. And similarly on volumes, they're undoubtedly down across all geographies. But that said, that's comparing to the very high benchmark of 2021, which off the back of COVID were just, crazy amounts of activity. So if you compare them to pre-COVID levels, they still look pretty healthy and sensible. It's just compared to that very high watermark of 2021, they look like they've come off, and they have. So there's lots going on right now. And I think the number one question we get from clients is, the forward-looking view of what's coming. And there's a few moving parts to navigate, I think.
And I think what you've also sort of summarised there quite eloquently is there's enough there in the coffers to make people think inevitably it's going to have to return. The question is when.
Exactly.
What about UK versus US? Do you see any significant difference between the US and the UK M&A markets and the sentiment towards activity?
Look, it's interesting. So look, at Raymond James, every one of our deals is international. Kind of every buyer list of buyers we kind of go and speak to will be across different geographies, and so it's fair to say there is some difference in sentiment. And I look back particularly to last year at the start of the summer, and there was quite a divergence at that point between, I'd say, Europe and the UK and the US. So the US at that point were much more bearish. I think over in Europe at that point we were still pretty upbeat about where the market was, but it felt like the US had turned slightly earlier. And I think I put that to the fact that the US probably feel a slightly stronger connectivity to the public market valuations, and they started to come off at the start of last year. Whereas in Europe, I think particularly the European private equity community perhaps feels slightly more shielded from that. There's not such a direct linkage to their portfolio. Fast forward to the end of the summer, say September last year, I think that gap had closed in terms of sentiment. I think Europe had caught up in its slightly more bearish views. Interestingly, from a valuation perspective, I think in terms of differences, there's probably now a greater alignment between the US and Europe and UK in terms of valuation. Historically, the US has always been probably a high valuation environment, particularly in the sectors I operate in. And what we saw some really high kind of increase in valuations, particularly off the back of COVID in the US, and they have come off quite markedly. In Europe, I'd say we never quite got to the same heights, and therefore we haven't quite had the same fall, and we've seen more of a normalization between the two, and a similar kind of trend, I'd say, in deal volume and activity. So, both those markets geographies are down, albeit I think the US is probably slightly more pronounced in its downturn. I mean, if I look at our own business, our year end is September, we've had another record year to September 22. Across Europe, we had another strong Q1, actually pretty much in line with prior year. Q1 for us, forgive me, is kind of calendar Q4 last year. US probably slightly softer in terms of overall activity levels, but very healthy none the same. So yeah, there's some subtle differences that we've seen play through, but I think some of that has perhaps normalised now in terms of coming to a more neutral landing point between the two.
And if we turn just to the tech market and tech M&A, looking at that specifically, how has tech M&A been impacted, and how do you view the outlook for 2023?
Sure. Look, I think it's interesting because when you take tech out specifically, I almost kind of start in the public markets and see what happened, because the tech sell-off in the public stocks started to happen pretty early last year. And that has been pretty pronounced, and we've seen that turmoil continue to play through over 2022. And interestingly enough, some of those SaaS multiples, as I just mentioned, the kind of rapid rise and the kind of some of the contractions particularly been seen in those SaaS stocks. So revenue multiples have come off markedly. I think that's all interesting, but I think what is more pertinent is the kind of shift in investor sentiment and preferences around tech. So the rule of 40 has always been quite a common metric in terms of looking at tech businesses, and that's basically a combination of revenue growth and margin. Now, historically, I'd say people were sort of less focused on the mix of that rule of 40. Did it come from margin? Did it come from growth? And growth has always been extremely high valued in tech stocks. What I'd say over the last few months or so, we've really seen it's back to this sort of flight to quality. Investors are preferring higher margin stocks over growth, and they are we've stepped away from sort of growth at any cost mentality that we perhaps saw 12, 18 months ago. So I think this has been quite instrumental in how people view the tech sector and tech M&A, and specifically such that I think from an M&A perspective, I say people are more focused on those more resilient businesses with perhaps higher margin. They're prepared to forgo some growth to kind of have more resilience in this market. And look, from an activity and valuation level, I think we've touched on some of those themes already, but volumes are sort of down if you compare them to 2021, albeit go back to the pre-COVID level, they look kind of more normalized and more in line.
And you touched on verticals there. As you look at the tech and services market, which particular verticals or subsectors do you believe will have the most potential to continue to attract competitive investment throughout 2023?
Sure. Well, look, I think before I kind of come on specific verticals, it's probably just worth again framing that in this kind of market environment, what are people looking for? They're looking for resilience. That's probably the number one factor, and that would have shifted from 18 months ago, where in more buoyant markets, resilience is important, but it's not. You don't feel it's going to be stress tested in the short term. Every investor right now is very focused on that this could become a very real stress test. Day one post acquisition, so they're very focused on resilience. And what does that look like? A key test around resilience is kind of what I would call mission criticality. how mission critical is the service, is the product, is the software you're providing, because that will help undermine, how resilient you can be when, if markets do get tougher. I think then on top of those kind of fundamental factors, you layer on the sort of about margins and growth. There you've kind of got the key criteria that people are looking for in these sort of market conditions. And I say that's not like a revelationary set of statements around what people are focused on, but it's probably the ordering is more important in the current markets. You go back 18 months ago, it would have probably been growth first, maybe margins at the bottom of the list. There's been a sort of as a turn. So as I then come to think about certain subsectors of tech which are most interesting, I think it plays into all of those themes. And look, there are many many kind of subsectors out there, not only in tech but specifically in tech, that we feel pretty bullish about as we kind of go into the coming months. Areas like governance, risk, compliance, GRC, I mentioned ESG. These are kind of subsectors that have macro themes underpinning them, which is driving growth, driving mission criticality. And similarly in edtech, if you're a sort of a K-12 software business, you don't just turn off these particular capabilities or software just because the market turns. These are mission critical to what's being delivered. So I'd say they're sort of certain subsets of software we feel pretty bullish around. What I would like to just kind of add is that I think it's fair to say that it's not only software that should be seen as resilient in these markets. There are lots of tech-enabled services businesses which we feel again will weather the storm very strongly. If I look to something like marketing, where I spend a bunch of my time, B2B marketing is certainly an area that is called out as being one of the most resilient subsectors of the market because of the kind of the buyer dynamics there, slightly different to the consumer piece, not as impacted by things like cost of living crisis.
One of the other questions I wanted to ask you about, Laura, was the process. So given the backdrop of the macroeconomic events that occurred, which we kind of touched upon towards the back end of last year, where we are now, I'm seeing processes elongate, or sometimes they occur over a more condensed time period against a backdrop of valuation volatility, right? Will the current market, in your view, change the shape and dynamic of the pre-deal processes moving forward?
Yeah, so look, I'll come on to the pre-deal piece specifically, but I think, look, for me, there's two elements to that. There's the kind of the speed of process you touched on. And look, as I mentioned at the start, given that kind of higher bar, I think it is fair to say that on average, processes are taking longer. And we advise our clients to assume that be the case. And as I mentioned earlier, that's because of higher scrutiny. People want to stress test a bit more, just to be perhaps more rigorous and thorough in their diligence work. I do want to contra that by saying, though, that we are still seeing for the premium assets, those businesses can trade very quickly. And by that can be a matter of weeks. We're not perhaps seeing the days type transactions that we might have had previously, but certainly a matter of weeks. And where there is a flight to quality, but with a smaller pool that kind of meet that quality threshold, you've almost got more competition. So I do just want to counter that from a speed perspective. In terms of your question around process shape and pre-process, again, I think I see that changing somewhat. And look, this has probably been something we've seen shift over the last 18 months or so, not necessarily just in the last few months, but it previously was the case that you could typically see more broad auction processes. And by that, you might have a formal IM that's going out to a slightly wider number of the market in different geographies, and then kind of filter interest from there. I'd say what we are now seeing a much stronger kind of concentration of is the kind of more curated processes, where it's a much smaller group of parties. They've probably got more access up front to have a dialogue, build conviction, to get them comfortable. I always kind of say, if an IM's landing on someone's desk and they're hearing about something for the first time, it's probably too late, because you kind of want to be having those earlier stage conversations, pre-process, letting conviction build over time. And I think that's what we're going to see, a stronger theme in terms of process shape and design.
The audience I speak to, typically the chairs or CEOs or owner founders of businesses, and occasionally investment directors who are looking to do bolt-on activity for their own businesses. If you could talk freely to them and off the record, what advice would you give them to get the most out of any M&A activity they enter into during 2023?
Sure. Well, look, for me, I think there's probably kind of three key things I'll call out. The first being that in this market in particular, investors want to buy results, not stories. And what do I mean by that? I mean that perhaps going back 18 months, 2 years ago, you could talk about maybe your growth expansion plans in a geography, and you might not have had to deliver that much of those plans. You might have said, look, this is what we're doing, this is the plan, this is the story around what we're building. And actually, that might have been enough to kind of get you through. I'd say in this current market, our firm advice is you need to have evidenced more of that perhaps than you might have done in the past. So I think it's to focus on, really showing those results, delivering those outcomes, and using that as in terms of your sales message, as opposed to just, this is what we're thinking about, this is how we're thinking about building. So that would be point one. I think sort of linked to that is point two, and a topic which can sound sometimes mundane, but it's quite close to our heart, is about preparation. That old adage of fail to prepare, prepare to fail. It can sometimes be tempting as a CEO, as a founder, as a chair to say, we've had this inbound approach, we're ready to go, we don't need to do much work, let's just get out there. The fastest way to create a failed process or a failed kind of M&A scenario is where you don't prepare. Because whatever those nature of those conversations, if it's one party, if it's 10 parties, 100 parties, you need to have rigorous preparation around your business, to have thought through the data. Because it's much easier to do that out of the spotlight, rather than you in the glare of the final IC and everything else. So the preparation piece has always been important, but I think it's even more fundamental in the markets as we currently are sat today. And I think the final piece I would just sort of really emphasize is that, remember that M&A is not a one size fits all approach, and it's a living, breathing thing. Again, sometimes we have clients who might have a very fixed view on the outcome, that, it will definitely be trade, it will definitely be PE, or whatever it might be. Again, in this market, but true in any market, you've got to kind of evolve the tactics, the approach, depending on what you learn from some of those early conversations, and recognize that it might take a few twists and turns. It might go in a slightly different direction, but that's okay. You kind of adapt and pivot. And so I think it's that sort of flexibility in approach. Again, the sort of what I always tell my clients is that my job is to create optionality for as long as possible. And for that to be best, you've got to kind of keep an open mind and be flexible about how things may evolve. So set your objectives up front, of course, in terms of what you want to achieve, but it might mean you achieve them a slightly different way at the end than you thought you might at the start, and that's okay. So I think there would be my three key pieces of advice in this market, but probably more generally as well.
Another question, which is unrelated, but I'm just curious more than anything, is there any correlation, or have you seen any correlation as an industry, not just purely specifically for Raymond James, with a potential downturn and the number of failed processes?
I think it's fair to say that there is the enhanced risk of kind of a failed process in these sort of the market conditions. And I think that, coming back to the point we discussed earlier about process shape and design, is kind of another reason why you're going to see much more curated processes. I think as we go into the next 12 months, you're going to see less of the, auctions. I am just formally landing on a desk. I think that feels a bit tone deaf. I think what you're going to see more of is kind of early stage conversations, people understanding there's a potential fit before you get too far along in what's called a process, and therefore minimizing the risk of any kind of failure or kind of not executing on your objectives. So yes, to answer your question, I think there is an enhanced risk of that in these markets, undoubtedly, because with more volatility, it becomes more uncertainty, and it's sometimes harder to call the IC, the strategic, what the decision making is kind of going on there and how they feel about the business. But I think the way you sort of mitigate against that is by being more thoughtful and creative around how you set up those conversations.
Okay. I know we're not quite in a downturn, because I think officially we're not in recession, but everything's sort of looking like it's indicating that way. But based on previous downturns, what advice would you provide businesses focusing on an event for 2024 to maximize the value as they navigate the coming months?
That's a good question. Look, I think it's really easy in these sort of market conditions for everyone to say, look, it's really tough. It's really hard to find growth, to find positive metrics. Off the back of periods like COVID, I was speaking to an EdTech business this morning. Every one of their metrics was bottom left, top right. Every one of them. In reality, it's probably going to be more likely that not every metric in the next 12 months will be flashing green. There might be some amber, there might be some red. But I think what I would say to businesses, to CEOs, to founders, to teams is you know, focus on the fundamentals. Remember, it's all relative. You know, resilience can come in different forms. And I think as long as you can evidence over the next 12 months that you're doing the right things, you can prove your resilience through maybe the fact your retention has stayed strong, or, you know, your growth might have come off, but you might still be growing. That's still positive, that you've delivered strong, healthy margins. So I think it's just try to stick to the fundamentals. Don't get too swept up in the kind of the broader rhetoric and noise. Just focus on your own business, focusing on harmonizing and maximizing what you can, such that when you come out the other side, relative to maybe other businesses, you have performed as strongly as you possibly can. So I just think it's the kind of old adage, isn't it? Stick to the knitting, focus on the fundamentals, be kind of clear about what you're trying to build and how you do it, and be thoughtful, and be able to kind of, in that period of, you know, maybe we didn't want to cut headcount because actually we're investing for growth here. So just be thoughtful and considered about the decisions you make, and as say, come back to those fundamentals of resilience, profitability, growth. You know, how do we evidence those? And I think you'll be in very good shape.
Laura, thank you very much. It's genuinely been a pleasure talking to you.
I appreciate it.
Lots of really good nuggets of advice there. But more importantly, I know you sort of referred to a couple of times the old adage, you know, one or two examples. I actually think, you know, it is the old adage exists for a very simple reason, you know, keep it simple and make sure you stick to your knitting. You know, these are key things that our grandmothers probably said to us, but at the same time, here we are in 2023 going into 2024. And those are the fundamental bits of advice which are critical, because I think sometimes people just get a bit lost. But it's been a genuine pleasure talking to you. Thank you very much for your time.
No, I really appreciate it. Great to speak.